The question was, what is the impact of Schengen membership or absence of it on industrial zones and logistics in your country? Well, Turkey is not being part of the Schengen area creates several challenges for its industrial zones and logistics sectors, especially when compared to EU countries that benefit from seamless movements within Schengen. While the EU-Turkey customs union does help soften some of the blow, particularly for industrial goods, it does not eliminate all the downsides. Because Turkey isn't in Schengen, trucks and freight vehicles face border checks when entering the EU. These checks lead longer waiting times, delays in delivery, and higher transport costs. This is especially a major issue for just-in-time production models common in industrial zones. Logistics firms and drivers face more paperwork and customs procedures at the border, which increases complexity and operational costs. The uncertainty around border crossing times makes it harder to plan efficient routes and delivery timelines, reducing overall productivity in logistic operations. Last but not least, the impact on sensitive sectors. Industries dealing with perishables or time-critical shipments are hit hardest by these delays, risking spoilage and contract penalties. We have customs union with EU since 1995. This agreement allows most industrial goods to move between Turkey and the EU without tariffs or quotas. This helped boost the economy. The customs union has played a key role in expanding trade between Turkey and the EU. A significant portion of Turkish exports goes to EU countries. But it's not perfect. It does not cover agricultural products or services, and it does not remove physical border checks. So delays and costs still remain an issue. Coming to the logistics, despite border bottlenecks, Turkey is investing heavily in its logistics infrastructure like ports, roads, highways, high-speed railways, and airports to boost domestic efficiency and better handle e-bound trade. According to the World Bank's 2023 LPI, which is Logistic Performance Index, Turkey scored 3.4 out of 5, ranking 38th among 139 countries. This is well above average. And the country has set an ambitious goal to break into the top 25 by 2028. In summary, not being part of Schengen places real logistics and financial pressure on Turkey's industries. Longer border waits, higher shipping costs, and bureaucratic hurdles make it harder for Turkish goods to compete in the EU market. Still, the customs union acts as a critical buffer, ensuring duty-free access for industrial goods and helping maintain strong trade links with the EU. With ongoing investment in infrastructure and potential updates to the customs union, Turkey is working to narrow the gap and strengthen its position in European trade. Delays mean more fuel usage, longer work hours for drivers, and penalties for missed delivery deadlines. As a result, Turkish products become less price competitive in the EU compared to goods coming from Schengen countries. The US has applied a general 10% tariff on imports from many countries, including Turkey. But for many Chinese goods, that rate now soars to around 125%. That massive gap gives Turkish exporters a real price advantage over Chinese competitors in the US market. With China becoming more expensive to import from, many companies are exploring alternative manufacturing hubs. Turkey, thanks to its strategic location and its custom union with the EU, is becoming an appealing option, especially for firms aiming to serve both US and European markets. In industries where Turkey and China directly compete, like textile, automotive parts, machinery, and plastics, these tariffs are making Turkish goods more attractive to US buyers. Both US and European firms affected by tariffs on Chinese imports are starting to consider investing in Turkey. With its access to the EU and more favorable US tariff treatment, Turkey is a logical base for regional production. In textile and apparel, this sector is leading the trend. With US tariffs on Chinese apparel much higher, many American brands are turning to Turkey. The country already has a well-established textile industry, and the lower 10% tariffs gives it a significant price edge. Reports show a noticeable uptick in inquiries and orders from US buyers. In auto parts, the US has slapped a 25% tariff on auto components from most countries, including Turkey. But with rising costs and uncertainty surrounding Chinese-made parts, some US automakers are starting to look toward Turkey as a more stable and competitive source. In plastics, machinery, and appliances, these sectors are also gaining attention. As US companies look beyond China, Turkey's existing strength in these areas make it a promising alternative. But the 10% tariff still applies. While Turkey has a relative edge over China, the 10% US tariff still makes it harder for Turkish exporters, especially in industries where profit margins are already tight. If tension between the US and China dragged down the global economy, demand for Turkish exports could suffer, despite their competitive edge. China is also working hard to reroute its exports to other markets, which could lead to more head-to-head competition with Turkish products elsewhere in the world. While some Chinese firms have looked at using Turkey as a stopover to dodge tariffs, the Turkish government and businesses seem focused on growing homegrown production instead. The aim is to build sustainable trade relationships, not just serve as a workaround. In summary, the US-China trade war is creating a window of opportunity for Turkey, particularly in key sectors like textile, automotive parts, plastics, and machinery. With a relatively lower US tariff, strong manufacturing capabilities, and a strategic location, Turkey is well positioned to benefit as companies rethink their global supply chains. In fact, some Chinese companies are even planning to shift part of their production to Turkey. A good example of this is the well-known Chinese automotive manufacturer BYD, which has decided to invest in Turkey and has reached an agreement with the Turkish government. BYD's total planned investment for a factory and the research and development center in Turkey has been announced as $1 billion US. The factory is planned to be established in Manisa a city known for its strategic importance to the automotive industry, where major manufacturers such as Fiat, Renault, Ford, Toyota, and Hyundai also have facilities. The factory is expected to have an annual production capacity of 150,000 vehicles per year. The agreement was signed between the Turkish Ministry of Industry and Technology and BYD in July 2024. The investment is estimated to indirectly create up to 25,000 jobs. Vehicles produced at the factory will be intended for both the domestic Turkish market and for export to Balkan countries and other European Union markets. Thanks to Turkey's customs union agreement with the EU, electric vehicles manufactured in Turkey may gain duty-free access to EU markets. That was the most remarkable real-world example of supply chain shift in Turkey recently. How does monetary policy, including the euro, affect investor interest and market stability? What lessons can be shared with Bulgaria? I'll try to comment as follows. Monetary policy plays a crucial role in shaping investor confidence and financial market stability. In Turkey's case, the way interest rates, reserve requirements, liquidity tools, the central bank communication are managed has had direct and visible effects on both local and foreign investor behavior. Interest rates is a major factor, but a double-edged sword as well. The central bank's policy rates is the most visible tool in the monetary toolbox. When interest rates go up, foreign investors tend to take an interest, especially those chasing higher returns. These are the yield hunters. This can help strengthen the Turkish lira, but it also makes borrowing more expensive for businesses and consumers. That, in turn, can slow down economic activity and hurt investor sentiment at home. When rates go down, borrowing becomes easier, which can give domestic demand a boost. But downside is that it may trigger capital outflows as investors look for better returns elsewhere. That weakens the lira and can stoke inflation. What are the other tools that matter? Reserve requirements is one. Raising them reduces the money banks can lend, which helps cool inflation. Lowering them, on the other hand, can stimulate lending and boost the economy. Next, liquidity operations. Central banks manage short-term cash flow in the system to keep market functioning smoothly. This is often done through buying or selling securities. And forward guidance. Clear and consistent communication from the central bank helps manage expectations, which is crucial for avoiding market surprises. Even though Turkey isn't part of the Eurozone, the euro still has a big impact. First, for trade and competitiveness. Since the EU is one of Turkey's biggest trading partners, the euro-Turkish lira exchange rate plays a big role. A weaker euro hurts Turkish exports, while a stronger euro boosts them. And debt servicing. A significant chunk of Turkey's foreign debt is in euros. So, when the lira weakens, the debt becomes more expensive in local terms. And reserves. Turkey also holds a considerable portion of its foreign reserves in euro, underlining how closely tied its economy to the euro area. What this means for investors. Let me list the factors. We start with currency risk. Exchange rate volatility is a major concern for foreign investors. If the value of the lira swings too wildly, it makes returns unpredictable. Next, interest rate gaps. Investors often look at the difference between interest rates in Turkey and other major economies. High rates in Turkey can attract short-term speculative flows, like carry trades, but they are also highly sensitive to sudden shifts. We are recently experiencing carry trade operations. We offer higher rates in local currency, where exchange rates remain relatively stable. This is like when you bring your euros into a high rate country like Turkey. You convert your euros into local currency to Turkish lira and place it at the local rates, which is high rates. Then at the end of say 1 year, you convert it back to euros, receive the local rate. And during this period, if the currency does not move up too much or stay at the same level, you get a very, very high rate in your local currency. This is what carry trade is. So, what Bulgaria can learn from Turkey's experience? Bulgaria, as a Eurozone member, operates in a very different policy framework. But Turkey's experience still offers some useful takeaways. Central bank independence is critical. When Turkey's central bank appeared to lose independence, markets reacted negatively. Bulgaria should protect the independence of its national bank within the ECB system to maintain investor trust. Inflation must be tamed. Turkey has struggled with inflation, partly due to long-standing issues like regional instability and the economic pressure of hosting millions of refugees. Bulgaria benefits from the ECB's inflation targets, but must still manage domestic inflation expectations through clear communication and responsible policies. Fiscal policies needs discipline. Turkey's monetary challenges have often been made worse by loose fiscal policy. Bulgaria should stick to responsible budgeting to complement ECB's policies and avoid market instability. Exchange rate stability is a major advantage. By being in the Eurozone, Bulgaria avoids the exchange rate volatility that Turkey regularly deals with. This is a major asset for trade and investment, and it's worth preserving by staying aligned with EU economic rules. Turkey's experience shows that monetary policy alone cannot fix deep-rooted problems. Reforms in governance, education, and market efficiency are crucial. Bulgaria should keep pushing forward on these fronts to make the most of its Eurozone membership. Turkey has faced sharp shocks due to high foreign debt and reliance on external capital. Bulgaria should monitor its external position carefully to maintain long-term resilience. To sum up, while Bulgaria is in a more stable position thanks to its Eurozone membership, Turkey's story is a reminder of how vital strong, independent institutions, clear communication, and constant macroeconomic policies are in attracting and keeping investor interest. These principles apply everywhere, Eurozone or not. How does your market compare to Bulgaria's, and where do you see opportunities for synergy and competition? I am not an expert of Bulgaria, and I took the information from open sources. So, if I say anything wrong about the figures, please forgive me. The Turkish and Bulgarian markets, while geographically close, exhibit significant differences due to their distinct economic development stages, population sizes, and relationship with the European Union. In market size, Turkey has a significantly larger population, which is approximately 85 million, and a much larger economy. As of 2025, Turkey ranks as the 16th largest economy globally by nominal GDP and the 12th largest by purchasing power parity. Its nominal GDP in 2024 was approximately $1.3 trillion, compared to Bulgaria, which has a population around 7 million and nominal GDP around $90 billion. This larger domestic market in Turkey can be a significant draw for investors seeking scale. In economic structure, Turkey has a more diversified and industrialized economy, with strong manufacturing, automotive, and textile industries. Bulgaria's economy is also developing, with strengths in agriculture, tourism, and some manufacturing, but it is generally less industrialized than Turkey's. EU membership. Bulgaria has been a member of the European Union since 2007, providing access to the EU's single market and its regulatory framework. Turkey is not an EU member, although it has a customs union with the EU for most industrial goods. EU membership offers Bulgaria benefits like free movement of goods, services, capital, and people within the bloc, as well as access to the EU structural funds. Bulgaria's currency, the Bulgarian lev, is pegged to the euro under the ERM2 mechanism and is expected to adopt the euro in the future, providing currency stability. Turkey's currency, the Turkish lira, on the other hand, has experienced significant volatility in recent years. For labor cost, generally labor costs in Bulgaria are lower than in Turkey, which can be an attractive factor for labor-intensive industries. Bulgaria generally offers a more stable political and economic environment compared to Turkey, which has faced periods of economic and political volatility. For foreign direct investment, while both countries attract FDI, which is foreign direct investment, Bulgaria's EU membership can make it a more predictable destination for some investors seeking stability and access to the EU market. Turkey, on the other hand, can attract investment due to its large domestic market and strategic location. Uh, if you look at the real estate market dynamics, Turkey's real estate market, particularly in major cities like Istanbul, is larger and more dynamic, but it has also experienced price volatility. Bulgaria's real estate market is generally more stable and affordable, especially outside major urban centers. For trade and logistics, Bulgaria can serve as a gateway for Turkish goods entering the EU market, leveraging its EU membership and established transportation links. Similarly, Turkey can be a hub for Bulgarian goods destined for markets in the Middle East, Central Asia, and Africa. The geographical advantage of Turkey provides efficient and cost-effective access to a large market of 1.3 billion people with a combined GDP of $28 trillion within a 4-hour flight radius. The geographical proximity and improving transport infrastructure between the two countries supports this synergy. Coming to the manufacturing supply chains, companies could establish different stages of their production processes in both countries to leverage the specific advantage of each, such as lower labor costs in Bulgaria for certain stages and Turkey's larger industrial base for others. In tourism, Turkey is a major tourist destination, ranking among the top 5 most visited countries globally. In 2024, Turkey welcomed 62.2 million tourists. Joint tourist packages could be developed, capitalizing on the diverse attractions of both countries. For example, Black Sea resorts in Bulgaria and historical or cultural sites in Turkey. For energy corridors, both countries play a role in energy transit. Cooperation on energy infrastructure projects could be mutually beneficial. For technology and innovation, collaboration in research and development, particularly in sectors where both countries have emerging strengths, could foster innovation. Bulgaria's EU membership could facilitate access to EU research funds for joint projects. Coming to the areas for competition, both countries compete to attract foreign investment, particularly in manufacturing and services. Bulgaria's EU membership and Turkey's larger domestic market are key competitive factors. In some sectors like textile, food processing, and certain manufactured goods, Turkish and Bulgarian companies may compete in the same international markets. A study indicated that while both Turkey and Bulgaria were initially focused on down-market textile niches, Turkey has shown better upgrading and less dependency on foreign buyers. In tourism, while synergy exists, the coastal resource of both countries, for example, Turkish Riviera versus Bulgarian Black Sea coast, also compete for international tourists. Hi, my name is Hakan Bek. I'm speaking to you from Istanbul, and I regret not being able to be with you today. I would have loved to be in Sofia, meet you in person, and learn from your experiences. Wishing you all a wonderful and productive Congress.